Most people think you need thousands of euros to start investing in the stock market. That you need a big salary, a finance degree, or some secret knowledge about which stock will double next year. But none of that is true. You can literally start investing with the price of a coffee. And the strange thing is, once you understand how the stock market actually works, you realize that the hardest part is not money, timing, or picking the perfect company. The hardest part is simply getting started. In this video, I'll walk you through the 3 simple questions every beginner needs to answer before buying their first stock ever. What to buy, where to buy, and when to buy. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every single year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Historically, stocks have returned roughly 7 to 10% per year over the long term. Not every year, of course. Some years are rough. Markets crash, headlines get scary, and people panic. But zoom out over decades and the market has consistently moved upward. Think about this for a moment. If you had invested 1,000 euros 10 years ago into a simple index fund, today that money would likely be worth somewhere between 2,500 to 3,000 euros. And that happened without trading, without predicting anything, and without doing much at all. That's the quiet power of compounding. Here's the strange part though. In Europe, most people don't invest in stocks and still don't do that. In parts of Central and Eastern Europe, only a single-digit percentage of the population owns stocks at all. Even in Germany, one of Europe's largest economies, the number is only around 10 to 15%. Compare that with the United States, where well over half of the population invest in the stock market. But this is slowly changing, luckily. People are starting to realize that investing is not gambling and it's not reserved for the wealthy only. It's simply one of the most powerful tools for building long-term wealth and creating financial independence, or even retiring early if you wish for that. Let's start with the first question beginners always ask. What stock should I buy? And this is where most people immediately feel overwhelmed. There are tens of thousands of publicly traded companies all around the world. Tech companies, airlines, banks, fashion brands, pharmaceutical giants, you can name any of those. The list is endless. So how do you choose? Here's the counterintuitive advice I always give to beginners. Start with companies you actually know and interact with in your daily life. Not because this is the perfect investment strategy, but because it helps you understand what owning stock actually means. Every time you buy a stock, you are becoming a small co-owner of that business. Imagine that for a second. When you buy shares of a company, you literally own a tiny piece of it. Of course, it's going to be a 0.0000001% of the company, but you're still a co-owner of that enterprise. So ask yourself simple questions. Do you drink Starbucks every morning? Did you recently upgrade your iPhone? That's Apple, of course. Do you order products from Amazon every month or even every week? Maybe you are wearing Nike trainers right now, or perhaps you prefer Adidas. Are you listening to Spotify, a company that actually started in Stockholm, one of Europe's largest tech success stories? Or are you watching this video on YouTube, which is part of Alphabet, of course, Google? Maybe you book your holidays through Booking.com, which is also a publicly traded company. Or think about travel itself. If you fly around Europe, chances are very high that you've been on Ryanair, Wizz Air or EasyJet. All of these are publicly traded companies. Now, here's the key point many beginners misunderstand. Your first stock purchase is not about making millions. Maybe you won't even make any money at all. It's about entering the game. It's about learning how companies operate, how stock prices move, and how markets react to news. Some of your early investments might go up, some might go down. That's completely normal. The goal is not perfection, the goal is experience. Because once you start owning companies, you naturally become more curious. You start noticing earnings reports, industry trends, product launches, and economic news. Suddenly, the financial world makes much more sense than previously. Think of your first investment as paying a tuition to the market. Ideally, you make money, but even if you make mistakes, you gain something far more valuable. That's understanding. The second question is, where to buy these stocks? And this part is actually very simple today compared to 10 or 20 years ago. First, you need a broker. A broker, basically a middleman between you and the stock market. They give you the platform that allows you to buy and sell shares. The good news for European investors is that we now have access to excellent modern brokers, many of them offering zero commission trading. But there are a few things you should always check before opening an account. First, make sure the broker is properly regulated in the European Union or in the UK. Look for licenses from regulators like CySEC, that is Cyprus, BaFin, that is Germany, or FCA, that is in the UK. Second, check investor protection. In most EU countries, broker accounts are protected up to around 20,000 euros if the broker fails. So in a worst case scenario, you will still get back your money up to £20,000 or 20,000 euros. In the UK, it is £85,000. It was £85,000. Now they raised it to £120,000 from 2026. Third, make sure the platform is actually easy to use. If the app is confusing, you simply won't use it. And finally, make sure the broker operates in your country. Some of the most popular options for Europeans today include platforms like Trading212, DEGIRO, Revolut, eToro, XTB, Lightsheet, or Scalable Capital. Now, here's something that changed investing dramatically in the last few years. It's called fractional shares. In the past, if a company's share price was high, you had to buy an entire share. If a single share, for example, cost 700 euros, you needed exactly 700 euros to buy that share. But fractional shares changed that completely. Today, you can invest 5 euros, 10 euros, 20, 25 euros, whatever amount you want, and still own a tiny fraction of that company. So even if one share of LVMH costs more than 400 euros, or Starbucks share costs more than $90, you can still buy a small piece of it. This is why investing is now accessible to almost everyone. The barrier to entry is no longer money. It's knowledge and discipline. And that brings us to the third question, which is, when should you buy? Many beginners believe there's some perfect moment to enter the market. Well, the truth is, sometimes there are really good opportunities. Occasionally, one-off events scares investors even though the company itself remains quite strong. For example, after the global IT outage in the summer of 2024, the cybersecurity company CrowdStrike saw its stock drop sharply as investors panicked. Another example for this was McDonald's in October 2024, when an E. coli outbreak temporarily scared consumers and investors as well, and the stock fell about 8% within a month. But within roughly half a year, the share price recovered back to the same level as before the incident. The same pattern always appears during broader market crashes. During the COVID market crash, many strong companies dropped dramatically before recovering over the following years. But here's the reality beginners need to understand. Major market crashes happen roughly once in every 7 to 10 years on average. Smaller corrections, maybe every 2 to 3 years. And individual company scares are absolutely unpredictable. They might happen next month, they might not happen for years. Waiting for the perfect moment can easily turn into waiting forever. That's why the most practical approach for beginners is simply this. Choose a company you understand, buy a small amount through a reliable broker, and start learning from there. Investing is not a one-time decision, it's a long-term process. The earlier you start the process, the more time compounding has to work in your favor. When you zoom out, the entire idea becomes surprisingly simple. You don't need thousands of euros, You don't need perfect timing. And you certainly don't need to predict the next big stock winner. What you need is curiosity, patience, and willingness to start small. Because once you own your first stock, the market stops being something abstract, the news, and becomes something personal. You start paying attention, you start understanding. And over time, that understanding compounds just like your money does. And if you want to learn more about how to build your first portfolio as a European investor, subscribe to the channel and don't forget to hit that like button to help the YouTube algorithm. See you next time.